Okay, so good afternoon, everyone, and welcome to today's webinar. We're back for another look at the situation in Iran, and specifically to help frame what it means for our MUFG clients at this particular moment. Let me start with some context. 6 days after the conflict began, when we were all trying to understand the lay of the land, we hosted our first client webinar on Iran. The response from our clients was extraordinary. We had 1,300 attendees in that webinar, and today we have a similar number registered, which tells me that the appetite for serious analysis hasn't diminished. If anything, it's certainly sharpened. The conversations our sales teams are having with clients have shifted over the past 10 weeks, if you can believe it, since the start of this conflict. It's no longer about what has happened, it's about what matters now. What are the markets missing? What are the real implications of the disruption to the Strait of Hormuz? And what could realistically change over the next few weeks? And this is exactly what we're going to try and tackle today. The situation is certainly moving fast. Literally overnight, Iran submitted a new proposal to the US. Washington cancelled its envoy's trip to Pakistan over the weekend. And while the ceasefire that has been extended a couple of times, it does seem to be holding broadly for now, efforts to turn this into a permanent agreement certainly appear to have stalled. As always in the region, the headlines move faster than the fundamentals. So our job today is to try and cut through all of that. A few introductions first. My name is Matt Fennessy. I'm based in Singapore, where I lead the global market sales for the GSB segment at MUFG. I'm joined today by three exceptional guests. First of all, Sanam Vakil is the Director of Middle East and North Africa Program at Chatham House in London. Her expertise spans Iranian and Gulf politics, regional security dynamics, and US foreign policy, with a particular focus on the evolving strategic landscape of the Middle East and its global connectivity. She is regularly consulted by senior government officials in the US, Europe, and the UK, and across the Middle East. And she is about as close to the pulse of these negotiations as anyone outside the room. Sanam, great to have you with us again. Thank you. Secondly, we've got Derek Halpenny, our head of research for global markets EMEA, based in London. Derek will give us his perspective on the broader impact of the Iran situation on the global economy, with a particular focus on G10 markets. Thank you, Derek, for joining. And finally, we have Lin Li, our head of Asia research at MUFG Global Markets, based in Hong Kong. Lin will bring the Asia-specific lens to the conversation, covering energy dependence across the region, supply chain exposure for corporates and consumers, the second round effect our clients here in Asia are navigating, and how that compares to what we're seeing in the West. We'll hear opening remarks from each of our guests in turn and then move on to Q&A. So all of our audience are welcome to submit questions in the Q&A function in Teams, and I will go through those and ask those to our panelists as we go. Anyway, I will stop there and pass over to Sanam to set up the situation and guide us on the way ahead. Thank you, Sanam. Over to you.
Thank you so much, Matt. It's a pleasure to be with you, and happy to share some opening thoughts about where we are in week 10, as you said. It feels much longer for me. We are, as of this morning, in a sort of limbo pattern, caught effectively between no active military conflict, no war, but also no peace. The US and Iran are in a standoff, and there's a number of factors here that suggest that this standoff is going to continue, in my view, for at least a number of weeks. This is, let me explain why. There are sort of two patterns playing out in the region. Obviously, the ceasefire continues, and that's very positive, but it's a tenuous ceasefire. Iran has been, for 6 weeks now, blockading the Strait of Hormuz, and the U.S. has countered that blockade, trying to prevent the movement of Iranian oil exports in particular. So the dynamics there are important, really, because the U.S. thinking, or in the Trump administration, this blockade is designed to pressure Iran economically. And it's important to remember the country has been facing an economic crisis for some time. Inflation is already above 50%. It's experienced protests in January, but this blockade is designed to pressure Iran to make concessions at the negotiating table. And in tandem to that, we have negotiations taking place. There was one round seen in Islamabad, a second round that has not yet come together. The first round was the first notable face-to-face meeting between the U.S. and Iranians in 47 years at the highest level, with Vice President Vance and Iran's Speaker of the Parliament, Mohammad Bagher Ghalibaf. That was a first step and a promising one, but by no means should we expect a quick win at the diplomatic table. And this is because, obviously, the issues between Tehran and Washington are complex and require much more than 5 bullet points on the back of a napkin. Iran is looking for a bigger grand bargain on its nuclear program, and ultimately seeking sanctions relief. I think another core demand for Iran is a guarantee that the war can come to a full end. And unfortunately for President Trump, the blockade, Iran's survival during the 38 days of bombing and the closure of the Strait of Hormuz has given the Iranian regime increased confidence, negotiating leverage vis-a-vis Washington. Here also, it's important to note that trust between the two parties has never been lower. They've never had a trust-based relationship to begin with, but it couldn't be worse than it is now. So the Iranians don't have a huge amount of confidence in the Trump administration. They've been bombed twice while they have been negotiating. And so they are seeking guarantees, and they do not want to surrender all of their leverage at the front end of an agreement. President Trump, however, needs a win at the front end of any agreement. And so the technicalities of any negotiation are very important, but the optics are actually equally putting pressure on both sides, because President Trump needs to present his version of history as victorious, that he's defeated the Iranians militarily, and he's secured a better, stronger, more comprehensive nuclear deal against Iran. And to do that, he needs the Iranians to surrender everything up front. So we're in a stalemate effectively with these negotiations, but there is back-channel diplomacy taking place. Iran did float this proposal where the U.S. would open the blockade, the Iranians would open the Strait of Hormuz. And this is being managed, this side of the agreement is being managed by the Omanis. The U.S. Administration, particularly Rubio, made comments last night shutting this down as a strategy. They think that the economic blockade against Iran is actually going to force Iran to make concessions. And so this proposal is probably not going to go anywhere. Here, let me just remind you about U.S. Thinking in this war. I know, Matt, you didn't want us to look backwards, but just a brief point. This war began with certain assumptions and intelligence information anticipating that the Iranian regime was on the brink of collapse and would crumble. These assumptions have been obviously proved wrong, have been driven by thinking within the Israeli intelligence services, and why I'm stressing them is because the Trump administration, and you're reading about this quite a bit in the press, has an assumption that Iran is going to break and make compromises because its oil storage is filling up. And the assessments from the intelligence community or traders and experts are that Iran will have to turn off its wells or shut down its capacity within the next. Already today was supposed to be the 2-week mark, and that hasn't happened. The expectation is actually quite a bit longer. My assessments say another month. And so the Trump administration might drag out this process, thinking that this calculation will force Iran to concede. That is an incorrect assessment. I'm telling you this right now. Why? You have to understand the psychology of the Islamic Republic. This is existential. This is about their survival. Secondly, they have experience in 2019 when maximum pressure sanctions began and the Trump administration tried to drive down Iranian oil to under 150,000 barrels being exported a day. They learned lessons in that experience in how to store and divert their oil. First of all, they're exporting from some of the smaller islands outside of the Strait of Hormuz. Second of all, they are blending and sending it to Iraq. Thirdly, up north to Russia. Fourthly, overland to China. This is by no means enough, but they have workarounds to deal with their capacity and storage issues. So the U.S. is making judgments I think in the wrong way. But, we can continue to play out the diplomacy card. In the meantime, while the diplomacy drags on, there will be continued maneuvering and proposals being floated behind the scenes. Ultimately, the United States wants a bigger deal on Iran's nuclear program and opening the strait simultaneously. Iran also seeks a bigger deal, but this is very much about sequencing of the concessions, and Iran needs that sanctions relief alongside guarantees. So I suspect these negotiations are going to take quite a bit of time within the next few weeks, if not longer. Second point, and then I'm going to wrap up. In the context of this stalemate, there's much that can go wrong. The U.S. continues to misinterpret Iranian signaling. President Trump is misrepresenting the Islamic Republic as being factionalized and divided. And this is sort of a talking point from the U.S. administration. The system in Iran is much more unified and much more aligned than what is being presented. And I think President Trump is trying to sort of pass the responsibility of this standoff to the Iranians, where that's quite not the case. What can go wrong? We can return to a military conflict. So we are walking a very fine line in the next couple of weeks to a month, where the U.S. could begin or could be forced to escalate in order to pressure the Iranians through military strikes as well. There are huge numbers of troops in the region. The U.S. had prepared for a ground invasion or the retaking of Hark, or the taking of Hark Island, for example. But likely, if military dynamics do pick up, it will be strikes on Iranian infrastructure, and that in turn will take us backwards, where the Iranians themselves that still have capacity to strike will be counter striking Iranian Gulf facilities simultaneously. So it's important to bear that in mind. Markets need to understand that this war is not over. We are in a lull, but things could certainly escalate, and by all accounts, we are going to be hitting a jet fuel crisis in the next month or so, and that also could put further pressure on the U.S. To reconsider its options. So effectively, both sides are under pressure, but not willing to make the necessary compromises, and this could lead to escalation. I'll stop there.
Sanam, thank you for that great framing and opening. And I think we want to come back to what the realistic paths ahead will be. But you mentioned the jet fuel reference there. Why don't we pass to Derek to just give us an overview on the overall market situation, Derek, why do you think that markets are being so resilient in this period of 10 weeks, as Sanam mentioned? And what's the path forward?
Yeah, thanks, Matt. Yeah, absolutely. It's a question we're getting quite a lot from clients. Like 10 weeks in, I don't think anybody would have thought that the US equity markets would have hit a record high, and basically euro dollar is down one big figure since the conflict began. So there's a lot of patterns that haven't really translated into what would have been expected. I think there's a number of factors. Number one, we shouldn't forget that going into this conflict, the stock of observable crude oil globally was close to a record high, 8.2 billion barrels of crude, and that meant the supply-demand dynamic at the start of the conflict was very, very favorable. Now, of course, those stocks are now being worked off, and at some point then that's going to start to have a kind of a more notable impact on price. But that favorable starting point, I think, has helped to contain the scale of the move in crude oil prices. And then linked to that, secondly, if you look at crude oil in real terms, you would have to argue that crude oil, even at these prices, is relatively cheap. So in real terms, we are still below the 12-month moving average peak that we reached post-COVID, and then well below the levels during the post-global financial crisis surge in commodity demand fueled by China in around 2012, 2013. And then, of course, even further below the levels that we reached in terms of peak oil in 2007, 2008, before the global financial crisis. So essentially, we just haven't hit the levels of crude oil that is prompting global investors to price in increased risks of global recession. And I think that has helped to stabilize risk, and ultimately that has limited the fallout in terms of increased volatility across credit, equities, FX, and rates. Then linked to that equity market lack of price action in relation to recession risks, I think what's also reinforcing the support for equities is actually the very favorable macro backdrop, and the fundamental backdrop for equities remains very, very positive in terms of what we've seen to date in terms of corporate earnings. So we're in the corporate earnings results season for the first quarter. As of Friday, we've had nearly 30% of companies that have reported, and of the companies, we're on track for a 15% annual increase in corporate earnings. That's the 6th consecutive double-digit annual growth in corporate earnings. So the fundamental corporate earnings backdrop is very supportive for equities. And then, of course, on top of that, just recently, we're starting to see another wave of optimism in relation to AI, with tech stocks outperforming. So the fundamental backdrop in terms of equities has been very supportive. And then finally, I would still say there's an underlying expectation in the market that a deal will be done. Basically, both sides want to do a deal. Iran militarily is obviously a lot weaker, so it has an incentive to get a deal done. And then on the US side, I think certainly President Trump has an increasing incentive to get a deal done. We can see his approval ratings are getting hit significantly. Real Clear Politics, for example, his disapproval rating is at the levels going back to the post period after the January 6th riots in January 2021. So his unpopularity because of rising cost of living is definitely going to have an increasing impact, and I think it will shape his incentive to get a deal done. Because if you consider, like, two of his big promises going into the election that he won was no more foreign wars and bringing down the cost of living. And essentially, if you're a voter that has voted for Trump because of those factors, you're probably not very happy at the moment. So I think that kind of explains the backdrop, I guess. To me, the most important element is equities. And after a 60% jump in crude oil prices since the conflict began, you would have thought certainly there would have been some negative impact on equities that would have spread across markets, but that just hasn't been the case. So to your point, in terms of going forward, what I would say to listeners and viewers who've dialed in, just because up to this 10-week period, we haven't had any kind of risk off or increased market volatility of any particular note, I wouldn't assume that that continues. And as Sanam had mentioned, in terms of the potential scarcity issues that are around the corner, those are still there. And I think once those become more evident to the markets, I think we're going to start to see the prospects of greater risk aversion and a bigger kind of pricing of recession risks. Now, looking at, refined products in Europe, I was looking at Amsterdam, the Amsterdam, Rotterdam, Antwerp hub in terms of some data coming from there in terms of refined fuels. And the one thing that has happened in the conflict is that we've seen refinery margins widening out significantly. And what that has done is it has obviously incentivized increased output. And there has been a notable increase in refinery output that has managed to keep prices relatively capped. But of course, as you go forward, we're now seeing inventories beginning to be run down because buyers prefer to use inventories rather than market pricing. And ultimately, inventories have come down pretty sharply, about 11 or 12% over the last couple of weeks. So we are beginning to see the signs that will push prices up further. The IEA, in its most recent monthly report, estimated a tipping point for refinery fuels in Europe potentially coming at some point in June. We also have to remember that we're coming into the summer vacation period. Jet fuel demand in the month of August is 40% higher than in the month of March. So ultimately, as we go into June, July, and obviously into August, we're into a much more dangerous period for starting to see physical shortages having an impact. We've already had, for example, Lufthansa announce the cancellation of 20,000 flights. Most of those are short-haul domestic flights, but we're going to see more of that unfold as the summer comes forward. And ultimately, I think once we start to see physical shortages and examples of economic activity being hit, I think that's when you're in a more dangerous period. Now, if all of that starts to happen, these physical shortages becoming more evident and seeing the economic impact, if that happens with the Strait of Hormuz reopened, to me, that's quite a different dynamic than if it happens with the Strait of Hormuz still closed. If we've reopened, I think there's an ability for investors to look through that economic interruption, given the Strait of Hormuz is reopened and given the expectations that gradually we'll see an improvement in supply. But if that happens with the Strait of Hormuz still closed, I think that's a game changer for the markets. And I think that's when we should expect investors becoming much more willing to start to price the risks of a much bigger negative macro impact. So I think that's what's to watch. And I think May is probably okay, but certainly as we get into June and onwards, we're in, I think, a danger period in terms of that dynamic. Based on the economic activity, the second point that's obvious to say is that if you look at the actual data that's come in so far, there's actually been relatively limited impact in terms of hard data. Now, if you look at consumer confidence, if you look at PMIs or the ISM in America, there's definitely evidence, in particular in terms of prices paid. For example, the ISM manufacturing prices paid index jumped nearly 20 points in 2 months, which is the biggest jump since 2016. But in terms of the hard data, it's pretty limited. Obviously, we had a strong jobs report at the beginning of April in the US. We've had very strong retail sales from the US as well. We've had GDP start the year in the UK up 0.5%. So the backdrop from a macro perspective here in the UK, at least going into the conflict, was stronger than expected. Germany is probably where you're seeing a bit more of the data in terms of weaker data. But generally speaking, we haven't had the hard evidence yet. And I think if we start to see the hard evidence of this, then I think we'll start to see equity markets become weaker, and with that, then volatility picking up. Okay, I'll stop there and hand it back to you, Matt.
No, look, there's plenty to cover off there, Derek, and I think you made some very valid points, especially that point around if we start to see these shortages playing out in the market while the strait is still closed, that is certainly a bigger risk. I can imagine that the market can see something through if we have reopened, but we're certainly not there yet, and those supplies are certainly running low necessarily just yet, but certainly being run down. So, I mean, maybe with that, Lin, you could talk to how Asia in particular is impacted by these fuel shortages and these fuel reserves in various countries around the region, and how Asia seems to be even more impacted than the West. But I'd love to hear your views, Lin, and then we can bring it all together.
Sure. I think compare with U.S. Market behavior, as Derek just mentioned, actually, stock market actually reaching the historic high. Actually, if you look into Asia market performance, for example, aside from the Taiwan and South Korea, which actually had, stock market index increased by 13%, 7% respectively, compared with February 28th. The rest of Asia, I would say, the performance declined. So I think that that reflect, the case you just mentioned. Asia are more exposed to this kind of Iran's war. And in my view, I think this kind of performance definitely is not a full recognition of potential damage. If this blockade will last longer, then market focus or market interpretation still is more focused on transit, kind of a very short, can still expect a short-term solution. So on the currency side, that tells a consistent story, like what we see on the stock market. For example, most of Asian currencies, I would say, depreciated. Renminbi was an exception, so that very much reflective fundamental situation of Asia individual countries' exposure on energy side towards the Middle East, towards the Strait of Hormuz, and their energy self-sufficiency, etc. So yeah, so the question is about the impact on Asia. Indeed, so because Asia is structurally more exposed, and most of the Asian economy is very much energy intensive and important, import dependent. And now Asia's imports from the Middle East for about 50 to 60% is crude oil imports, and roughly 30% of is natural gas imports coming from Middle East. So this kind of a huge amount largely have to pass through the Strait of Hormuz. So in terms of the gas and oil usage relative GDP for Asia is about 4 times of GDP. This is almost twice the size of Europe's share. And the net oil and gas imports is about 2.5% of GDP. So that actually tells us there is a significant, large terms of trade shock. So now we are more and more focused on the potential increasing risk of supply shortages. So yeah, so it is easy to understand the first round of impact on the prices. I think that we are already seeing some signals or kind of situations that the supply shortage is taking action. So we are seeing some second round of effects. So it does not the impact of Iran does not just stop at headline CPI and PPI, etc. It triggers second round of effects through freight, through utilities, through food imports, and can lift up the core inflation and inflation expectation. Also, we're going to see, the impact will be transmitted through to second round, this kind of a sectoral impact, including petrochemicals, fertilizer, freight, and they also kind of create some hidden inflation tail. So from that, I think that I think it's fair to assume that if the energy shock is transit, I think that Asia overall growth likely to slow from last year's 5% to 4.4% for the 2026. However, if getting severe, meaning that if it, because we're talking about hypothetical kind of calculation, so if situation persist for a year, so that means that it will squeeze GDP accumulatively by 1 to 2 percentage points by the end of first quarter next year, and it can push up inflation probably more than 3 percentage points. So this is our estimation right now. So, that will affect, Asia currency movement. So that will create a lot of a negative impact on the current account balance. So you worsen the current account balance for most of the Asian currency, given that a lot of countries are actually net importers. And it will create a negative impact on we would expect, the performance of certain currencies, such as ASEAN, some of the ASEAN currencies with, economy, large exposure to oil imports and kind of low buffer on the stockpiles. So they are likely to suffer more than others. So should I just stop here for questions, or I can elaborate more if there's questions going forward?
Yeah, look, I mean, Lin, I think we could come back to Derek's point about shortages actually playing out and where we might see fuel shortages showing up first. So maybe we can have a think about that and which countries are impacted. But I do want to come back to Sanam, because we're getting some questions in the Q&A, and if I can remind the audience, please do ask questions there. We certainly want to get your thoughts and questions answered. So Sanam, the first question here is regarding the Iranian leadership. So what is the real relationship within those in authority and power in Iran? Who are the key players really making the decisions, and what does that imply for the situation over the near to medium term? They've gone on to ask, named a few people here, but I'm keen to get your thoughts on who you think is pulling the strings at the moment when it comes to Iran.
Sure. I think that is what's at the forefront of most people's minds. The system is certainly transitioning, and so it doesn't have the same single figure that is calling the shots. When Ali Khamenei was alive, he was sort of the final decision maker, if you will. And currently, his son, that has been selected as the new supreme leader, was recently reported that his injuries are extensive. He's in hospital in a hidden location. He's disfigured. He needs a prosthetic. He was in the building, that was struck on February 28th that killed his whole family effectively, alongside many other commanders and individuals. So I don't believe has that final arbitration, the final decision-making authority right now because of his condition, but also because the system is transitioning. He has, however, been running his father's office for a number of years, for decades, effectively, from behind the scenes. So he has close relationships with the people who are currently working in a consensus-based structure to make decisions. The key institution where all of the strategy on diplomacy and military dynamics are made is the Supreme National Security Council. That's always been where these decisions are made, scenarios are discussed and presented. And right now, I would say the consensus-based nature of the system still holds. They work to come up with the scenarios and drive the strategy forward. It doesn't mean that they don't agree with each other all the time. There's certainly factional differences. This has always been a factionalized system, but it's institutionalized and not personalized. So the key figures, as I see them today, are Mohammad Bagher Ghalibaf, who is the Speaker of the Parliament. He's an insider, he's pragmatic, conservative, but a deal maker, and this is certainly a unique opportunity for him professionally because he hasn't ever been successful in winning the election for presidency, for example. Another key figure is the Minister of Defense, Ahmad Vahidi, who is a hardliner within the IRGC. Then there is the representative, the Supreme Leader's representative in the Supreme National Security Council, an IRGC hardliner whose last name is Zulqadr, and he is important in this structure. I would say the president, Masoud Pezeshkian, also has a vote and a voice. He is much more inclined to think about the economy and the economic motivations of deal making as well. And other people behind the scenes that have been there for quite some time. Mohsen Rezai has worked in the office of the Supreme Leader, Ali Akbar Velayati, as well as the current foreign minister, Abbas Araghchi. So these are just some of the people that are sitting in the room where they, hash out these key issues. There is a small, but of course feisty neoconservative movement in Iran, and they are opposed to negotiations. They're opposed to concessions with the United States. And while they do have a base, they don't have a huge ability to restrain the system. Iran's parliament has come out in favor of the Speaker of the Parliament. Most people want a deal. Everyone realizes that this system's survivability is contingent on a deal and sanctions relief. So, effectively, I do say this now publicly. President Trump is incorrect when he is presenting the Islamic Republic as infighting and unable to make concessions.
Okay, so I mean that was a follow-up question here, and I mean you did mention factions there within all of those people that you mentioned, but what is the likelihood of an internal split? Okay, maybe Trump is overplaying it, but surely that disagreement could spill over, and we do see some sort of internal split in the Iranian leadership.
It's nothing severe or meaningful. Yes, of course, they have divisions, but to me, they're no different from the divisions between Rubio and Vance. And frankly, the system is always unified in times of crisis. It's designed to focus on self-preservation, but they are not in the mood of compromising with the US president on some key issues. That's what's problematic. their psychology is also important to understand. They feel very buoyed by their ability to have survived the war. They feel confident and they're overconfident, perhaps. And this is where they too can miscalculate.
Okay. So why don't we pivot to you, Derek? I mean, this is, you mentioned, that we haven't seen a huge amount of hard data as yet, but this week is an important week of central banks. We just had the Bank of Japan today. No change in rates there. Maybe if the situation had been different, we might have seen a hike from the Bank of Japan. But with the statements coming out from these central bankers and their rate decisions that are happening, do you think that we're seeing any hard evidence coming out this week that might give markets pause or reflection?
Yeah, like again, going back to when I was talking earlier, another catalyst for markets potentially becoming more volatile and equities suffering more would be, of course, bigger moves in rates. Now, we've already had big moves, mainly in the UK, actually. The move in 2-year and 10-year gilt yields in the UK has been roughly double what we've seen in Europe and the US. And then in Japan, we've seen the least move higher in yields. But of course, going into the conflict, the markets were already expecting the BOJ to raise rates. I think from a BOJ perspective, what was interesting today is, number one, we had 3 dissents, which is unusual for a BOJ monetary policy meeting. Tamura and Takata, 2 of those we've seen before dissenting, but Junko Nakagawa, she dissented, which was a surprise. Now, she only has 1 more meeting left, so I don't think that really is that important for the medium-term outlook. But I think what it does show you is that a shift is taking place, and I think there's certainly a good chance that the BOJ could raise rates at the next meeting in June. And then, the one thing that we've seen is that markets expect the Fed to be a bit more tolerant in terms of inflation risks going forward. More tolerant certainly than the UK in terms of the Bank of England and the ECB. And I would agree with that. If you look back to the Russia-Ukraine conflict and the start of that, the ECB and the Bank of England were ultimately too slow. Well, actually, so was the Fed. Most central banks were too slow. But of course, the composition of the Fed today, the fact that the Fed have a dual mandate, it gives them a bit more flexibility. And we've got an incoming new Fed chair, so a bit of time for Kevin Warsh to settle in as the new chair. The fact that a number of Board of Governors have a kind of a dovish leaning suggests the Fed will be more tolerant. Whereas I think we'll probably get some dissents this week from the Bank of England. Hugh Pill, the chief economist, looks like he's going to vote for a hike. Catherine Mann maybe as well. So we could have a 7-2 vote to keep rates on hold, but the forecast certainly being indicative of the Bank of England potentially raising rates going forward. And then for the ECB as well, I think the communication will be, we're still in a period of uncertainty, but we cannot avoid the need to act if the inflation dynamic continues as it is at the moment. So certainly we're priced for hikes. So I'm not necessarily suggesting we're going to get a big move in rates this week on the back of all these central bank meetings. But I think the direction is clear. And certainly if we don't get a big equity market correction lower, then I think 2 hikes from the ECB, 1 from the Bank of England is certainly very feasible.
Okay, that's interesting. I guess I want to pivot to Lin now and ask about China's role in all of this. We've got the meeting between Xi and Trump coming up mid next month. That's been delayed from the previous date. But what role do you think China are playing in negotiations, and how crucial do you think they will be to the whole situation? And Sanam, after that, I'm keen to get your thoughts on China's relationship with Iran as well.
Okay. Hi, Matt. So yeah, so the news actually now is anticipating a meeting between Xi and Trump to happen on May 14 and 15. However, there's no official confirmation from either the Chinese or U.S. government about the meeting yet. So I think that considering, yes, I wanted to provide a little bit more about, not just about, what China's role on Iran as a solution to Iran war. I think it is likely to cover a broad range of topics, right? So China is still on the pause of tariff war with the United States. So I'm assuming that topics like fentanyl will emerge, and also China may seek some tariff rate reduction. And in the latest data from United States, it shows that U.S. actually imposed a effective tariff rate of 30% on China imports from China as of February. So there's a chance, and there's a positive tailwinds could come from there. And also, I think that it is likely we are going to see some other tailwinds. For example, a more stabilized mechanism for two parties to establish a management mechanism to ensure sort of a stable relationships. So that could happen, and also some kind of a joint statement on the economic interdependence that could happen. And also some collaborations or on the global issues, especially on the climate change, AI safety, and one of the key component of that is the joint effort on Middle East stability. It could happen. So I don't see much of a detailed kind of analysis, highlighted in recent media yet. But I can imagine, along the line of this kind of geopolitical kind of topics, Taiwan issue or Taiwan matter, and also South Sea matter can become a topic as well. And also, I think that we could expect sort of some development along the line of Trump's transactional style, meaning that China to purchase some U.S. agricultural goods or even energy products that you can see from China's official data. China has stopped import energy, crude oil, and natural gas from United States, completely stopped since mid of last year. So there's a chance that increase some of that. So, but there are headwinds also again. So it's not all good. So, for example, the recent kind of situation in the United States, it seems like U.S. is stepping up the tech control on China. So, on the tech and security side, whether or not the rivalry status becoming even deepening, so that can be create some headwinds. And also, I just mentioned the Taiwan and South China Sea matters. It can create uncertainty or even headwinds. And Ukraine and related sanctions, this area may be not so easy to have a compromised kind of outcome. So yeah, I think China has been voicing out some not so to the degree that to the degree that many would expect. But China has been voiced out its stance on the Iran war. Yeah, I think Sanam maybe be a better person to discuss that. So I will see for the upcoming Xi and Trump. I still think that I'm relative basis. Probably we're going to see more tailwinds than headwinds. But having said that, given the nature of these two economies' competitive nature, we shouldn't really expect a too rosy outcome to come. Thank you.
So I guess in order to see those tailwinds, we probably, it would be much better if we'd seen some sort of resolution in Iran before then, right? So, I mean, Sanam, I'm keen to hear your thoughts about China's influence and impact in the Iran framing.
Yeah, very quickly. I mean, China is playing a behind the scenes role. It's not willing to do too much, at least publicly, or put too much political capital to helping President Trump right now. And I think Lin is quite right. China's positioning, and it's important to note that the trip is not confirmed. So this assumption that it's going ahead is really wrong. And I think for both sides, the war will need to come to an end for that trip to go through as well. So the Chinese are working through Pakistan to support the ceasefire, but then sort of build out different proposals for the negotiations. The reality is the Chinese can play a role to pressure Iran, and they continue to, of course, be recipients of whatever Iran is sending out in terms of crude. But they're not currently willing to throw too much skin into this game. Obviously, they're frustrated by this war, but they see the ability to extract some concessions from the American side. They're also, being impacted from the Gulf side as well. I mean, the Saudis are still, able to sell, and so is Abu Dhabi through Fujairah and Oman. But China is very much caught between its economic relationships in the Gulf and its longstanding, albeit frustrating, relationship with Iran. So, this is where it is right now. It doesn't mean it won't play an important role, maybe as a guarantor if a final agreement can be reached. But for now, I'm not very optimistic that we're going to see more.
So, I mean, you touched on the broader Gulf economies and countries there. Like maybe we could get your view as well, Sanam. Given your focus on the Middle East, how do you see the continued situation in the Middle East? I'm thinking, of course, about Lebanon, but also Israel's involvement. We haven't heard them speaking up as much as Trump recently. Middle East dynamics in general.
Yes.
General comment there.
Okay, so as there is this stalemate in the Persian Gulf, the United States and the State Department in particular, under sort of Rubio's guidance, is trying to make progress, or at least seemingly make progress, on the Lebanon-Israel file. The ceasefire there has been extended. Obviously, there was a uptick of violence yesterday, and the U.S. is pushing for some sort of, there's not going to be normalization, which is a American fixation, but there will be hopefully a non-aggression pact at the end of this process between the Israelis and the Lebanese. But simultaneous to that, nobody can articulate how you get Hezbollah to lay down their arms. I don't have more answers there, but we will see at least a public-facing progress in that arena while the ceasefire is in process. There will be continued strikes there as well, and the Saudis are trying to play a role in supporting the Lebanese government. But I mean, there is no solution to the Hezbollah problem. So that's what everyone has to bear in mind. In the context of the Gulf states, obviously they remain very frustrated by the status quo. There's a sense of respite, if you will, that the military strikes have come to an end, but the Gulf states themselves don't have any clear solution to what comes next. They want a deal. They want to see a weakened Iran. They want a deal that restrains Iran's ballistic missile and drone program and its support for proxy groups. They're very worried that President Trump will cut them out of any deal, and that the US will get distracted and leave them with this wounded but still aggressive Iran in control of the Strait of Hormuz. So the two Gulf states that are playing the most active role are Oman and Qatar. Oman trying to come up with some arrangement to open the strait, while Qatar is also part of the group or the coalition of the willing, trying to support the Islamabad process. And so there it's Oman, Qatar, Egypt, Pakistan, Turkey, and Saudi Arabia playing an important role as the so-called coalition of the willing, working on that diplomatic track. And yesterday, the Iranians were also in Moscow, and that's because the Iranians are trying to negotiate an opening of the strait through the Gulf countries and trying to find a resolution on the nuclear program, with the help of Moscow, trying to split the portfolios apart. This strategy, as I explained at the beginning, is not likely to bear fruit also because, again, of the differences with the US administration.
All very confusing as always for that region. I guess being a global markets webinar, we can't finish without a comment on the US dollar. Derek, can you maybe finish off with views around currencies and what we can expect in the weeks and months ahead?
Yeah, like again, going into the crisis, we would have anticipated a stronger dollar than what we've had. Rough regression work would indicate for every 10% move higher in crude oil prices, you get about a 0.7% drop in euro dollar. That would have implied where we are today with crude oil that we should be 4.5% lower on euro dollar, which of course we're not. So the impact has been more diluted than expected. When we look at kind of our rolling correlation analysis, as you'd expect, Brent is still a strong correlation with the US dollar, although it's weakened a little bit in recent days. But on a kind of a 1 month window, rolling window of daily percentage changes, what stands out is the strength of the correlation between the US dollar and say VIX. The strength of that correlation, it's basically at a level we haven't seen since 2012. So that's a positive correlation. So low VIX, low dollar, high VIX, higher dollar. That correlation the strongest since 2012. And similarly with the S&P, negative correlation, very strong. And what has weakened quite notably is yield spread correlations with the dollar. In fact, that correlation, the DXY weighted spread versus DXY, it's the weakest correlation since the global financial crisis back in 2009, 2010. So very interesting that it really is about risk. It's about the equity market performance. And that to us is the most telling development to explain the lack of dollar strength on the back of what has taken place so far. And then, yeah, to translate that going forward, Matt, obviously what we were talking about earlier in terms of the potential risks of the macro hit becoming more evident, if that does materialize, I would certainly think still that the dollar could strengthen. There's been some speculation about, the dollar losing its safe haven status. A lot of clients have been asking us that. But my answer to that question is, well, we don't know because we haven't had a risk off. And really, if we do go down that road, I would still expect the dollar to strengthen. Now, it may not strengthen for as long or as extensive as previously. So I do think the safe haven status is being partially eroded, perhaps because of the uncertainty of policy in Washington. But I would still expect it to strengthen if we start to see bigger declines in equities.
The safe haven status, it generally played out as you would expect at the start, right? The dollar stronger, Swiss franc stronger. It was actually the yen that was the most interesting move there, right? That didn't seem to play its part, and that's probably more oil linked, right?
Yeah, like I think since COVID, the yen's reaction function has changed because a lot of the risk-off episodes that we've had since COVID are inflation related. And if they're inflation related, then the front end of the US yield curve doesn't drop. And that means dollar yen remains supported. If we had a deflationary shock, like a big drop in equities, and the front end of the US curve fell notably, I would expect the yen to strengthen in that backdrop.
Look, we're coming up on the hour. I do want to finish with our very special guest, Sanam. Final words on where you see scenarios playing out. I'm holding the gun to your head. How do you see this panning out in the next weeks?
I mean, I think that let's say the most viable scenario is we're stuck in this stalemate for the next few weeks to a month. And out of this stalemate, I do see the probability for escalation and a return to military conflict. So I think that should be on the forefront of everyone's sort of thinking and pricing. I don't think that we're going to get a serious deal in any short time period before the end of May. The best case scenario would be that there is some sort of agreement for both sides to climb down on opening the Strait of Hormuz and the Persian Gulf. And then from there, they try to pressure each other on the nuclear file and beyond. But I only think that is going to come after there has been a step back from the brink. So my best case is we stay in this limbo. Fingers crossed that President Trump doesn't decide to get trigger happy again. But I think that, we could creep into that by the end of May.
And with that, the question is, when does risk sell off? So look, I want to thank all of our guests. Thank you very much for joining for this follow-up webinar. And thank you to all of our clients for registering and joining. It's fantastic the interest that we've had in this webinar and in our webinars in general. Please reach out to your MUFG sales rep for any follow-up. We can certainly put you in touch with our panelists here today, and we can certainly direct you to our research website, mufgresearch.com, where you can find all of our daily publications that are coming out on the Middle East, on the Iran situation, but of course on the global economy in general. I will leave it there. Thank you very much to everyone, and I wish everyone a safe future period as we negotiate this very strange situation in the global economy. Thank you very much.
Thank you.
Thank you. Thanks.